Welcome back to the channel. In today's video, I'm going to be breaking down to you how you can start trading options and really what are options as a beginner. So if you're not familiar with options trading, it is mostly kind of what I trade, and most of you guys probably know me as an option trader. Now, I don't only trade options, I trade a bunch of other strategies, but options, it appeals a lot to a lot of beginners because of the potential gains that options have. If you ever scroll to Wall Street subreddit or something, you see someone had made over 1,000% gainer, 10,000% gainer, and most likely those gains only came from trading options. Trading options is a leverage tool that traders use to make a ton of money. Now, when you're making a lot of money, there's also going to be some risks, and we will be covering both the rewards, the risks, what are options, and all those other things in today's video. So make sure you sit back, relax, hit the like button, comment down below, and hit the subscribe button, and let's get straight into the video. First and foremost, let's go over the definition of options. Options are simply a contract that gives a buyer and a seller an option to buy a certain amount of a stock. So let me give you an example. Pretend Apple is currently trading at $120. Now you have an option contract that says, hey, you have the right to buy 100 shares of Apple at $110. Now you might be like, well, that's a $10 discount, which means if you remove that $10 gaining off the price that currently is of Apple, you know, of course I will want that contract, I will want to sell that contract to make a profit and take those Apple shares. So now that's how an option contract gets its value. Essentially is what we call a strike price. Now, a big thing to know with options is all option contracts are going to have an expiration price. So whatever your option contract is, it will somewhere in there say the expiration of that contract. They always expire on a Friday if you're trading any ticker. If you're trading overall markets such as SPY, QQQ, IWM, SPX, and NDX, those are going to expire every single day. So keep that in mind. And this is where it comes in. If your contract reaches the expiration date, it will lose all its value. So let's say your contract says, hey, this contract expires on May 15th. I don't know if May 15th, 2023 is a Friday, but I just imagine it as. Then if it hits May 15th, the market closes, and then the next day, May 16th, you're going to notice the contract's completely gone, which means you lost all your money. So you have to be careful, you know, beware of those if you're a complete beginner to sell your contracts or execute your contracts before you hit the expiration date. Now, the contracts, unlike underlying shares, don't only have expiration dates. They actually have a few different components to them. A contract price is called a strike price. A strike price is how much you paid for the contract. So I'll give you an example. Let's say we have a contract that has a value of 1.00. Now, the value is not actually $1. It's going to be $100. So you take the strike price, and you will see that on your broker account, depending on how your broker does it, you can find the contract prices, and then you multiply it by 100. So if you see a contract that's valued 10, the wins, it's $1,000. It's going to cost you $1,000 to acquire that contract. If it's 0.50, guess what? It's $50 to acquire that contract. Contracts get their prices one of two ways. The first one we talked about, which is this, how we get a strike price, which is the value of the underlying asset minus whatever the number is of your contract. You know, whether it's 100, 101, 102 of how much you can buy that action for, the shares for. The other way they get their price is an extrinsic value. An extrinsic value means how much time you have on those contracts. So if your contracts expire in 2 weeks, are going to be less valuable than some contracts that expire in a month. The reason is because the more time you have on your contracts, the more likely it is to hit the price that you want it to be. So let's say you have 110 contracts and Apple is at 108. If you have 2 weeks, it's more likely to hit 110 than if you have 1 week expiration. So that's called an extrinsic value. What's really to know about that is that every day goes by, that value diminishes and diminishes. Now, how do we find out, how much your value will diminish? Well, that's going to lead me to the next topic, which is the Greeks. So the Greeks are how contract prices really move. There's a delta, gamma, theta, and those are going to be your main ones. There's also something called implied volatility and some other ones that are probably a little less much of a factor. Implied volatility is going to be really important, but we'll cover them one by one, and probably each one of those Greeks can have its own videos. But let's first off with one of the biggest ones, which is the delta. The delta is going to tell you how much the price of a contract is going to move based on a $1 move on the underlying asset. So let's say, for example, let's take our Apple contract. Let's say you have an Apple contract you spend $100 on. So now you have a 1.00 Apple contract. Now, if Apple is currently sitting at 105, the delta will be, let's say, a 1, then whenever Apple moves to 106, your contract just gained a whole point value. So from 1.00, it's 1.10, right? And that's how that's going to move. So that's how you can easily adjust based on the underlying asset where your contract will move and how much it will move. Next up, let's talk about the theta. The theta is how much will your contract lose value every single day. So remember how we talked about the extrinsic value a couple minutes ago? Well, the theta will tell you how much your contract will lose if you hold it overnight into next day. So let's say Apple is sitting at $105, nothing changes. Only thing that happens, it's May 15th, now it's May 16th, and how much will your contracts lose if you just simply held it and Apple did not move. So let's say your contract is a 1.00, it's on May 15th, May 16th, Apple stays flat, did not move at all, but you had a theta of minus 0.2. Now your contract went from a value of 1.00, which is $100, to a value of 0.8, even though the contract price did not move. So even though the share price, Apple did not move at all. So you just lost about 20% of your contract value because of that. So you have to be very, very careful if you're holding your contract to make sure you're looking at the theta. The theta is going to be very important, and it's easily accessible on your brokerage account. Now, the risks that you have to understand when you're trading options are you could lose all negative 100%. You could lose all of it, which is very, very rare to lose everything if you're trading shares, because it's almost impossible for a share to go a negative 100% and get delisted. It's very, very hard, and you can probably sell it along the way. But with contracts, it's very easy because we talked about just price movements, and we talk about the theta, we talk about them expiring as well, right? So losing 100% can be, I want to say common, but it could totally happen. So the risk is a lot higher, but so is the reward. Because contract prices have an infinite upside, which is very much like shares do. The only thing with contract prices having an upside, they tend to move much, much more than an actual share price. Because if the share price moves 10%, the contract moves is going to move 10 times that, right? 100 times that, sorry, because you have 100 shares, right? So that's, you're going to have a 1,000% gainer versus a 10% gainer, plus or minus some because of the extrinsic value that we spoke about. Option contracts move very, very risky, up and downside, and there's two ways to buy them. You can buy what we call a call option. That means very simply, if the price goes up of an option, the option will also go up. But there's also a way to short a certain asset called a put option. A put option value goes up whenever the underlying asset is going low. So whenever the underlying goes up, you're going to buy a call option. So if you think a stock's going to go up, buy a call option. If you think a stock's going to go down, buy a put option. Very, very simply. Now, all the Greeks are going to act exactly the same with both options. Now, let's touch base on the Vega and the Employable Agility, because those two are a little complex to talk about, but are very important in understanding how the contract options move. Employable Agility is the expected volatility of a contract in any certain moment. Let me give you an easy example. Let's say it's a random Tuesday and there's no news coming out. Now the S&P 500, the SPY contracts will have an average volatility of, let's say, 40%. But now we changed that random Tuesday to an FOMC meeting date. This means now investors are expecting a huge move in the market due to the potential volatility that this news event could cause to the S&P 500. And now the implied volatility went from 30% to 80%. This means your contracts will move much slower than they would on a different day, because the expected move is going to be much higher. And the moves of a contract, how much a contract moves, is valued by something called the Vega. The Vega will add extrinsic value based on the implied volatility each 1%. So you look at the Vega, and let's say it's 0.02, and the value of your implied volatility is 30%. This means if the implied volatility goes to 31%, your contract price will automatically gain 0.02%. That means a lot of times if you buy something before a huge news event, if you remember we talked about AMD, the value will go up a ton because the news came out and now the volatility is much crazier. An easy way, this is kind of hard to do all the math on really quickly, but an easy way I like to describe this to beginner traders is whenever there's implied volatility, there means more traders, more investors are interested in a certain asset, so they're trading a lot more. And if someone's trading a lot more, you gain premium on that thing. Imagine it's a house, right? Imagine you're gonna go buy a house in a really nice area. There's gonna be 20, 30, 40 people kind of bidding against you on the house, which means the premium of the house, so the house is worth, is gonna get bid up higher and higher. It's very similar with contracts. Well, if you go look for a house somewhere in the Midwest and not people are interested and the value is 200,000, more likely it's going to sell for 200,000 or lower. But then in the same house that's valued 200,000 in South Florida is going to get bid up to 400 or 500,000. That's an easy example for me to describe to you what implied volatility and Vega have the effect when you're trading options. I believe as a beginner, you should probably not just straight jump into options trading, because options trading is going to take up all the fundamentals that regular shares trading, penny stocks trading, forex trading, any other type of trading, and just add a bunch of new information and a lot more variables to them, making it a lot more complicated. So I think as a complete beginner, you should focus on understanding fundamentals, how price moves, how candlesticks moves, price action, supply and demand, and everything in between. And once you've really mastered that, then you can kind of move on and explore the options route. I'm not here to discourage you from learning from them, right? It's going to take you hours of learning, get yourself some courses, whatever it is. But the reward of understanding options can be very, very profitable, because you're leveraging a little bit of money to potentially making a lot of money. The reward definitely outweighs the risk, in my opinion. That's what I really like with options. Is very friendly also for small accounts. Most of the contracts, for example, I trade between are $100 or less to about $300, $350, really on the higher end. Which means a beginner, let's say you have $2,000, you cannot really afford buying 5 shares of the S&P 500 because every share is like $400, but you can definitely afford buying 5 $75 contracts for the S&P 500 and trade ticker symbol SPY. Of course, before you jump in, I'd highly recommend looking at how to trade options on a paper trading account. For example, if you trade with Thinkorswim, you can do that. If you trade with interactive brokers, if you're out of the US, you can do that. If you trade with Webull, if you're in the US, you can do that, and this is probably going to be the best way. You really understand how they move, because there's a lot of variables to them, and there's a lot of these Greeks that realistically most of the times you're not really looking at it once you really deeply understand options, because you kind of understand how a certain contract move. That's why I like to trade when I'm trading options, S&P, Tesla, and a lot of the same tickers, because I kind of can expect how they're going to move. And then I just have to take account, for the most part, any type of news events, earnings report, or if there's something going on like a Federal Reserve meeting or like a CPI report or something like that. I have a bunch of videos on the YouTube channel if you learn more about options, going over options, trading options, how to choose the strike price, how to choose the expiration date, and pretty much anything in between. So make sure you guys go check that out. Hope this intro to options kind of give you an idea. If you have any questions, leave them in the comments below. Maybe I'll make a video on them. And it's a great topic that we can talk about for 10 hours straight. As always, make sure you hit the like button, comment down below, and peace.